Unit 5, Operations Management, Subtopic 5.5, Break-Even Analysis. Lesson objectives. By the end of this lesson, you should be able to understand unit versus total contribution, understand how to use charts to find BEP, margin of safety, and target profit, understand how price and cost changes impact break-even quantity, understand the limitations of break-even analysis as a tool. Break-even analysis is a visual tool that helps managers see the relationship between costs, price, and profit. A business breaks even when it sells just enough to cover all its production costs, resulting in zero profit and zero loss. It's a vital strategic tool for deciding if a project is too risky to pursue. The contribution shows how much a product contributes to the fixed costs and thus to the overall profit of a business after deducting the variable costs. Contribution per unit equals price per unit minus variable cost per unit. The contribution per unit is needed to calculate the break-even point. Total contribution equals total revenue minus total variable costs. Total contribution can also be calculated with this formula. Total contribution equals contribution per unit times number of units sold. After establishing the total contribution, profit can then be calculated. Profit equals total contribution minus total fixed costs. Profit equals contribution per unit times number of units sold minus total fixed costs, which corresponds to profit equals total revenue minus total variable costs minus total fixed costs. Profit equals total revenue minus total costs. The break-even quantity is the minimum number that must be sold so that all costs are covered by revenues. At the break-even point, there's no loss, but no profit either. They can be calculated numerically or graphically on a break-even chart. The break-even quantity can be calculated in two ways. One, using the contribution per unit method. Break-even quantity equals fixed costs divided by contribution per unit. The second method is using the total costs equals total revenue method. Once the break-even point is reached, it is said that the company is breaking even, and it then starts making profit. This is called the margin of safety. Margin of safety equals current output minus break-even output. Based on the break-even quantity formula, two other calculations are possible. Target output profit equals fixed costs plus target profit divided by contribution per unit. Break-even revenue equals fixed costs divided by contribution per unit times price per unit. Higher fixed or variable costs raise the break-even point and reduce the margin of safety on the break-even chart. Revision tip. Questions about break-even are asked frequently, especially in Section A of Paper 2. So make sure you know how to answer questions about break-even. There is an element as mathematics because business management has a quantitative dimension, which is why the Section A of a paper is always about quantitative analysis. Assessment tip: always identify the unit first. Clear units make contribution and break-even answers accurate. When interpreting a stimulus, focus first on identifying the different elements. To calculate contribution per unit, always ask yourself, what is the unit? Clearly defining the unit ensures your final answer is expressed correctly, whether it's products, services, or participants. Assessment tip: do not forget to label the break-even chart fully with the axes and lines. Some marks are always awarded for this. These marks are easy to achieve, but they are also easy to miss out on if you forget to add the labels and the names of the different elements. Likewise, you should use graph paper provided by your school for the exam or use your ruler. Assessment tip: understand the difference. Contribution equals sales price minus variable costs used to cover fixed costs and build profit. Profit equals sales minus all costs, variable plus fixed. If costs exceed revenue, profit is negative, meaning a loss. Lesson recap: break-even is where total revenue equals total costs. Contribution per unit pays off fixed costs until the break-even quantity is reached. Always label charts accurately, keeping the margin of safety in units. Why target profit and price formulas help in planning. Remember, the model relies on estimates and assumes a single product firm with static market conditions. Final recap: effective production planning involves understanding how price and cost changes shift your break-even point. While the model is a powerful quantitative tool, managers must also consider qualitative factors and the accuracy of their data. The effectiveness of the model depends on these forecasts, which limit the usefulness of predictions in a changing environment. This brings us to the end of the lesson. Thanks for watching.